And we are live, live, live. Good morning to you, Vernon. And how are you doing, my brother?
Good morning, thank you. How is your morning so far?
Good, good, good. It is what we call Wealth Wednesday. So, where obviously we deal with wealth markets, wealth issues, how to actually get your wealth portfolio running. That's the key conversation today. So, for everyone, get yourself together. It is Wealth Wednesday. For as many of you today. And obviously, Wealth Wednesday being a kickoff point where we do actually try and go through how markets are doing, how portfolios are going, and how other occurrences are actually happening on the market for everybody who wants to know where to put their money. Remember, yesterday, which is Finance Tuesday, is how you handle your money. Today is where you put your money. This is multiplication and maintenance of money. And then tomorrow, we'll deal with entrepreneurship and how you make your money. Now, remember the other part of this equation, but which I also wanted to get everyone in line with from this week in terms of the conversation point for this week is how we. The conversation point for this week is how we actually learn from mistakes. Now, remember, people, one of the things I really want to stress to you is you don't have to always make the mistakes to learn from them. In fact, if you're wise enough, you learn from other people's mistakes, what they warn you. And instead of always trying to make sure that you're the recipient of mistakes yourself, be open minded to making mistakes and learning from them. That is a big, big, important lesson. I also want to stress this out, Vernon. Just because you make a mistake, it doesn't matter. It's not the end of the world. You just always have to decide to learn from a mistake. Now, your investor journey or your entrepreneurial journey will not be perfect from the beginning. In fact, it's never perfect. You have to actually give room for the bumpy patch where you are going to get things wrong at the beginning. And that's why you always start small. This is the problem with everybody. A lot of people are always trying to catch up too fast or move too quickly or get to the destination too fast. And as a result, you end up making a lot of huge mistakes. But if you actually make mistakes early when things are small, you get the knowledge of those mistakes very early without with not a lot of damage. Okay, so that's what we're all trying to get to. Try and avoid too much damage in the mistakes that you have that you end up making. So today is going to be, as I said, Investor Mistakes Day. And there's quite a few things on the barrel today, but let's get down into the market as it stands. Vernon, we are continuing to see the Kwacha, and say hello to that handsome fella there. We're continuing to see the Kwacha continue to get stronger and stronger and stronger. But it did pick up a little bit yesterday. So we did see the Kwacha move down to 19.46 the USD. Remember, we topped out somewhere close to about 21.5, and we see the rand also dropping down to 106. So these are signs of at least imported inflation figures may not be too strong. Remember yesterday we did see food prices globally are starting to come down. So if our currency is also starting to pull back as well, this is a double up here where we're now seeing that imported prices might actually start to slow down, and we might see less of the potential danger. But remember that we're still online for a potential fuel hike because of OPEC's cut that might actually put the price of fuel back up a kwacha. So that 93 where that got wiped out might return back. That's where we're on track for. But right now, we've seen that the kwacha has come down by about 3.7% on the month, and it's only up. The dollar is only up 7.54% year to date. Remember, this was actually sitting at 17% at one point. So we've actually reversed a lot of the gains. A lot of the gains right now have actually been reversed. In fact, from the top of where we've seen that 6.6% down from just the last week alone, where the prices were actually coming down. We're also seeing that about same thing with the rand, where we've seen about 8.86% down movement on the rand as well. So this is actually good news in general in terms of the fact that the currency seems to be getting stronger. What's the driving force? We'll see that after tax season if this is sustained. Now, the other part that we're looking at is the trajectory. As you can see, the trajectory of the kwacha is of the dollar is continuously flattening, which means that we're actually seeing some sort of change in trajectory in that direction. The green one, meaning the current trajectory, the one 5 days ago, is actually showing you that this is what's happening, that we are seeing that a flattening of the currency, meaning that things seem to be getting better and better. For now, we're not sure how long this will last. Again, remember, this is temporary information. We cannot react fully to it until we've eliminated the effects of tax season, because that is partially part of what actually happens here. I know everyone will rush to sentiment because we love the politicization game, but the reality is there are factors such as tax season. There are factors that come to play, and this is one of them. We're not seeing too much drastic movement in the bond market to signal that there've been any flows in. However, we are seeing some possibility. Bond market is at all-time high in the secondary market. We did see a trade upwards. The bond index has broken through 1,000 for the first time, which means that we have continued to see a run-up in terms of in GRZ bonds on the secondary trade market. We've actually raised most of the losses. Bonds are up 6.87% year to date. Also in the USD, one of the good things that has happened is if you're an offshore investor of bonds, or if you're a Zambian who's holding bonds offshore, your bond portfolio has actually gone into the positive finally year to date, up 0.48%. And in the last week, it's gained by 6% from the double effects of bonds generally rising. 8% in the last week, from bonds rising 1.3%, plus the FX rate also rallying about 6.7%, has doubled up to finally push your portfolio into the positive this year. Against the in USD. This is in USD. If you're local, your bond portfolio has always been in positive this year. But if you're offshore in USD, it's finally going into positive this year. We've also seen interest rates coming down, signaling there is bond buying happening, but it's domestic bond buying. There's a lot of domestic activity pushing the bond market and pushing the stock market upwards. So this is good stuff that we're actually seeing in terms of the strength of the local market for now. But the bond index is holding positively as well. On the commodity market, we did see copper move back up, but it hasn't gone back up to the 9,000 run. It's still just trying to flirt with that 9,000 figure, but 8,893, up 1.1% from where we read it last time, with oil up 0.65% and still trading about 85.49. There was some data coming in from the US showing that crude inventories did rise and instead of fall. So that's putting downward pressure, and you can see that the oil trend is starting to flatten out. Gold is still holding at 20.55, up down 0.38% and up 10.64% in dollars. You can actually see gold is actually having a strong run in dollars, but obviously in kwacha, the US dollar is actually having its biggest effect on the gold market. But now, if you're in the crypto craze, you did see that Bitcoin has broken through 30,000. So for the crypto in terms of in US dollars, and that's pushing crypto closer and closer to the 600,000 mark. Now, I always say to people, please always exercise caution, but we never get listened to anyway. Investors are trying to eye the next rate rise. And Reuters News has actually said major cryptocurrency, the major cryptocurrency breached 30,000 level for the first time in 10 months, adding to steady gains of investors raising bets that the Federal Reserve will soon end its aggressive rate hiking cycle. So they are trying to bet that sooner or later the Federal Reserve will do that. So this is based on speculation more than anything. The cryptocurrency has got a lot of speculation in it because the investor case is not tied to use cases yet. We are still trying to work on it, but as an investment case, remember, keep it as a diversification of your portfolio. Don't exceed 15%. I'm going to tell you the same story over and over and over again. But Bitcoin is up 7.1%, up 96.91%. So here's the reality. If your stock portfolio, say, has been underperforming, and maybe your bond portfolio has been slow performing, and you kept 5% of your money in Bitcoin and Ethereum, that 5% would have added 3% to counteract whatever slowdowns have happened in the other parts of your portfolio. That's how these things balance. So when things are very risky, you kind of make sure you risk balance. It's called risk balancing. You don't just throw everything equally in, you risk balance them so that to make sure that you are not harmed, you're not harmed horribly, and you keep things stable as much as possible. So it's called downside protection. Ethereum also up 71.31% in kwacha. By the way, these are in kwacha reads. So the reason they're also starting to come down a little bit is because of the strengthening of the kwacha. Gold is down 1.97% because of the strength of the kwacha versus also the loss in gold in dollars yesterday. So we are seeing gold is up 18.98% year to date. Year to date, this is what your main market categories are looking like here. Bonds up 6.9%, stocks up 8%, USD up 7.5%. So the stock market is finally beating the USD, and you can see that we're starting to get a bit of risk on trading in our economy. The market is starting to posture towards risk. 19% in gold, 96.9% in Bitcoin, and Ethereum 71.3%. One day we'll remember to change that date for everyone. That actually is as of yesterday. This is now where our four horsemen of the trade battle are giving us right now. Inflation reads, we're seeing Brazilian CPI started to slow down with Chinese PPI declining. Brazilian CPI is good because that's good for meat prices. So that's good in terms of meat prices starting to come down with a stronger kwacha. That might push, and also global meat prices are failing to rise as well. So those three components will give us some meat price issues there. Chinese PPIs also are declining 2.5%. That's in terms of our electronics imports that we export a lot from China. That should come in a little bit cheaper. US crude inventories rose as well, and Japanese PPIs, which is global electronics, also declining as well. So we're seeing slowdowns in the supply chain and inflation side. South Africa's net reserves did rise. That also means that we might see a strong that's pushing for a stronger rand, while their manufacturing contraction deepens, meaning that the cost of the things they're producing might start coming up. Remember, South Africa is 30 to 35% of our imports. Oil continues to rally, mainly because of OPEC cuts, and the Egyptian inflation rate, showing that regionally we are rising, has risen higher and higher, though core inflation did start to come down. That's good for Egypt, meaning that the supply chains might be cooling off finally. In terms of interest rates, we are seeing Chinese loans market jump drastically. There were huge amounts of loans as the Chinese economy is trying to loosen up lending, and 3-year notes, US 3-year notes, did decline in interest rates. So we are seeing some positive signs, but on the negative, the short-term treasury notes are still flat or rising. Japanese lending did slow down slightly, and US and UK mortgages rose from 7.2 to 7.02 to 7.22%, up 0.2%. So that's also some signals that we're starting to see that rising. U.S. small business optimism is up, but starting to slow down in momentum. And then EU retail sales as well as U.S. sales also slowing down, while you are also seeing Korean unemployment tick upwards. And finally, Japanese factory orders did rise. So what are we seeing in terms of our four horsemen? And a neutral view of inflation, interest rates slightly coming down, but in the short term still staying upwards. Trade still slow. There is still signs of very slow trade with factory output. Industrials still starting to show some signs that there are some fight. There is a bit of fight back in them, but we are still in a very tender position, very, very tender position globally. That, Vernon, is our market roundup, also with the global outlook. Now, in terms of what data we're looking at before we get into our deep dive today, in terms of what data we're looking at today on the economic calendar, is that we are also, the biggest one we're looking for is US inflation. US inflation reads are on the biggest expectations for today, but we are looking for US mortgage rates, which are also expected to come in today at 6.4% last time. We're expecting inflation reads coming out of America, both core, non-core, and we're expecting core, non-core, and also the index itself. We're also expecting the Bank of Canada to expect it to make its rate decision today. It's expected to keep interest rates at 4.5%, while we are also awaiting more crude inventory data coming out of America. With more data also closing up the market, we'll be expecting trade data coming out of Japan, coming out of China. Chinese trade data coming in weak will speak a lot for copper and slow down copper output, while we are also expecting the Korean monetary policy board meetings to also give us what their outlook is. So in general, we are expecting it is interest rate day today, and also there will be FOMC minutes coming out of America. So generally, it is the inflation day. The biggest read for us is U.S. inflation. If U.S. inflation, along with the strong jobs number, comes in from last week, then we are expecting that the interest rate cycle will continue to rise. Okay, bits of news that are coming out right now. We are seeing Sorry, good morning to everyone, and we get a few notices from people. Kenya, Wix Muluba has actually said Kenya has run out of money to pay salaries, and the president is refusing to get a loan, saying the government will use tax money. Does it mean Kenya does not use its T-bills? What's your take, Munyumba? Kenya does use short-term financing. It's just that the government does not want to get any long-term loans. Generally, the Kenyan structure has been to utilize tax revenue to pay salaries and to pay for operational costs. That's actually just been the way they've been running things. Uhuru Kenyatta actually talked about it recently, that Kenya has for the first time been continuing to do this, and they don't want to use debt for operational costs. So there's a philosophy in Kenya to utilize these things. Now, do they utilize their T-bill market? They probably do, but I'm not sure why the president might be posturing in that way. Some things are also just virtue signaling people, but they might have just also had a bad T-bill run. Uh, but generally, most countries do use their T-bills specifically for short-term costs and short-term projects. Right. All right, so everyone, let's get back into the ring with what we call our deep dives. So we've got two big deep dives, and here, Vernon, is a big one. China in talks with emerging market economies to work out debt compromise. Okay, on emerging market economy, sorry, China talks on emerging market economy to work out debt compromise. A new plan, if agreed, could see China drop its demands for multilateral lenders such as the World Bank and the IMF to join taking losses. That concession would be in return for multilateral lenders and regional partners such as Asian Development Bank and African Development Bank more explicit commitments to provide fresh, low-cost financing, including grants to countries whose debt have been restructured. Now, what does this mean? This sounds like a lot of gibberish, but what you don't understand is that actually affects Zambia bigly. Okay, as Donald Trump would say, bigly, folks, bigly. And what that simply means is that you've got China's biggest stumbling block is saying if we're going to take haircuts on our debt, explain why the IMF and the World Bank are not. And we're refusing, as the Tswanas would say, "Kya we're refusing to actually do anything of the sort until we see them take that off. Now, what we're seeing from China is they actually now they're open-minded now to a new way of doing things and saying, look, fine, we'll leave these ones off the table. And if that sticky point gets taken, that's China back on the negotiating table and here to make progress. Now that means that if that is the case, remember Zambia's money from the IMF has been held back until China and America finally reach. China and the creditors finally reach an agreement. And China's sticking point has been the World Bank, IMF. So they're saying, look, fine, you can take the World Bank and the IMF off, but what we want are deeper commitments for concessionary loans, explicitly stated to all the countries. You're not going to leave our loan portfolio feeling the pain, and then you guys get to trundle off like the winners here. You then have to step in, pick up the bag, and give good loans to these people. So this is a sentiment game because what China is basically playing at is saying, look, if you want us to take the IMF and the World Bank off the hook, then you have to commit to more loans to every indebted nation whose debt has been restructured and to give them very good economic support. That is the only trade-off here. So obviously now it's back to the stinker is sitting with them. So the main thing, Vernon, I think that's been playing around has been the sentiment. Because right now, China has looked like they've had very bad. China has had a very bad reputation in this one. They've had a reputational risk because they've been. So yeah, now they've been going around saying, "Look, you're the one going around saying you are the friend to Africa. You're the friend to Africa. Meanwhile, you're the one who's leaving us here in the holding the bag." So right now, China's biggest concern is now trying to make sure they look like they can play, like they had to play ball. So China now has thrown it back and said, "Okay, fine, we'll agree to this if you do this now." So now it's up to the World Bank and the IMF to also clean up their reputational risk. Because if they say we can't commit to good loans for people, now people start to question their motives. So as you can see, it's like a game of tennis, okay? Back and forth on who is going to have the reputational risk in this situation. But we're getting closer to a deal. Words came out yesterday from Janet Yellen, who also said she's optimistic that China will agree on technical debt restructuring issues. You have to watch out for that word technical. It is a doozy. It just means in theory and not exactly an outright one. Says, I've been encouraged by China's willingness to provide specific assurances with respect to Sri Lanka and as regards as a positive. Yellen told news in the conference yesterday. I'm hopeful that we will actually get a bit of progress out of this first meeting and of sovereign debt roundtable on a set of technical issues. I feel encouraged that we made a bit of progress, and I hope to make more. So that's the sentiment slowly coming out. However, we've heard this song and dance multiple times. People take it with a grain of salt. We've heard it multiple times. Unfortunately, it has not always yielded much. so we can't always speak to it. But for now, these are the debt conversations that are coming out now. These drastically affect Zambia because remember, once you hear a deal has been made, Zambia's debt has been restructured, Zambia then gets reprofiled. Okay, that's a big one. Zambia's debt gets reprofiled, and with Zambia's debt getting reprofiled, or Zambia in general gets a reprofile, once we get reprofiled by S&P, that means our risk yields start to come down, and as global interest rates start to come down as well, then you see the flood of foreign capital that comes into your bond market. So, to everyone who's a bond investor, pay attention. This could actually affect your yields if these people pull a quick one. Okay, I'm not sure they'll pull a quick one. I'm just telling you if they do, that changes the trajectory of the bond market very quickly because then the ratings get done very quickly, and then you start seeing movements in the FX rate and also movements in bond interest rates, and therefore that'll push people. So just be on pins and needles here and start prepping yourself for a transition, because for China to start saying, here's a way that we can do this, that's a change in the dynamics, and that's a potential change in the dynamics. So you don't want to always just keep yourself bound into the bond market. There is part of the stock market that you should start looking at. Potentially, where are the dividend stocks? Now, here's the reality about the stock market that I want to put to everyone. The stock market is not underpriced. Last time when President Hichilema stepped in, and we saw the reprofiling of our nation and money came in, the stock market was underpriced. That was the big change. The stock market this time is not underpriced. Okay, it was then, it is not now. Okay, so the stock market is fair priced. A lot of stocks are fair priced, and a lot of the stocks last year were a little bit tough. So, what you have to prep yourself for, okay, just mentally prep yourself for, is now it's time to go in and look for stocks that have got three things. And this is what Warren Buffett tells investors all the time: always look for three things. Which companies have got good economics? Okay, in other words, where do you see the actual business doing well, the actual fundamentals of the business? Do you see their revenue growing and their costs being contained? That's all you need to look at. Who is scheduled to make a good profit going forward? Two, who has a good management team? Because management is the most important thing. And three, is it fair priced? Is it underpriced, or is it fair priced? That's all you need to look for. So that's what you're looking for. Who are the most likely to pay dividends, cash flow generating stocks? That's what you're looking for. And then you put those into your mix. Okay, especially if you're a novice investor or you're coming out of the bond market or the property market, you've just got to look for stable growth investments. You're looking for stable growth and potential dividend payers. Those are the ones you're trying to transition to. Don't shock yourself with a huge one of trying to go for growth stocks, trying to push a portfolio growth too hard. Just get yourself in there, ease it up slowly. Okay, so that is what you need to look at. So it's not a free fall like last time. It's not going to be the same stock market rally like last. Yes, the all share index is still at all-time high and it's heading towards 8,000. That's because of the CEC rally. But that's 1-2 stocks that really did that 1-2 punch. Now you have to prep yourself for a market that's a bit less easier to buy and more for the investing. But then again, this is not about trading. This is about investing. So you may have to just quickly also start opening up your stock portfolio while simultaneously having your bond portfolio. And I'll talk about that in our things on making mistakes. So that's the conversation happening about debt. There is some movement in the negotiations, but we still have got no definitive date as to when this is going to be set. And we have got a stalemate situation. The IMF also has also issued out a stern warning about global growth. The IMF warns deeper financial turmoil could slam global growth. The banking sector's contagion risk, though contained, added another layer. So whenever we saw those banking issues with Credit Suisse, now they said, look, it was handled correctly. Though it was contained, it has added another layer to global complexity. The IMF is now forecasting global growth at 2.8%. It had it at 2.9%. And for 2023 growth to be at 3%, which was at 3.1% for 2024, meaning that it has ratcheted down its growth expectations, marking a sharp slowdown from the 3.4% growth in 2022 due to tight monetary policy. Now, the main things it is seeing is inflation resilient, banking sector, and the oil shocks. These are the three areas that the IMF is citing where the issues for the global economy are coming. So watch out for this. Global growth does affect copper demand. Okay? Copper demand is drastically affected by global growth. And that, Vernon, is our roundup of the issues in the deep dive. Main thing there, Debt is moving, but the world is slowing. Debt conversations are moving, the world is slowing. Now, today we are talking about our chart of the day, but Vernon, I don't know what your thoughts are. You see any hope for our debt negotiations, or is it another day of promises coming in?
Regards to the debt restructuring process, on a personal level to begin with, I do not like date. So obviously, I'm not really for the idea, of so with what the Minister of Finance, of course, is bringing into view, I can't confidently express that the restructuring seemingly is in a promising trajectory, great results. But from what the IMF is promising, and this is actually my thought immediately when I heard about the credit facility to be given, the 188 million dollars that the IMF is promising to disperse to Zambia. My thoughts were, this is more of a trap
On
again,
condition,
offering you
on
more money.
condition that you fix your debt with China,
Mhm.
that you fix your global debt. Remember, it's on condition. They're not going to release that money
Yes,
until the debt deals are reached.
with China. So already, there are these parties, China and win over Zambia. And for Zambians, like we have always alluded on, that there is something that these both, countries have seen that is quite rich in Zambia. They want to still hold on to Zambia in a debt so they can be able to win and control one or two aspects. So ideally, I think we, as Zambians, we should wake up on that note and see how we can leverage from the because already they're noticing that the other seemingly wants to get more attention or more of than the other country. The sooner either of them will give up on us, that will be the end. So now is a time where we can leverage on the relationship now and build, so we can be able to find ourselves in a stable situation, no debt. So what is also hindering a lot of things around this Zambian economy is still, of course, the very perspective that we're owing people money, and these are huge sums of money. So ideally, the Ministry of Finance could possibly, do a bit more of open-minded about the whole scenario. I feel if we can have a bit more consultation before we can conclude with the debt restructuring. I feel even the delays. I don't even understand what the delays are really about. If they can be brought out in public and say this is where we are and this is where we're trying to go, I think even more people could actually advise and consult and find ourselves in a more stable situation, a more promising situation. Because right now, everybody just knows that there's debt restructuring going on, and IMF is promising to some more money at a condition, and Zambia is currently owing money. But how do we work around getting ourselves out of that money? Now, people, it'll be very agonizing to understand that the debt restructuring will be expedited because there is a 188 million dollars pending somewhere when we work on our issues with China. That would be a wrong stimulation. If we can work around the debt situation because we want to get out of it, that would be right. But if we'll be propelled to work around the debt restructuring as fast due to wanting more money, on the wrong trajectory and find ourselves even in a more tangled trap at the end of the day.
So I think what the IMF is doing is not really targeting us. I think they're targeting the country, right? They're working on the fundamental basis that Zambia will be kept afloat by the IMF. So they're comfortable dragging their feet in the negotiations. But I think what the IMF has now started to realize that, look, if they pull that off, then these other ones now have to start sitting down and making it. And I just want to correct that it's not just your debt issues with China. It's your total debt portfolio, your external debt portfolio. We need to come to an agreement with all of them, be it the private bondholders and China, everyone. Okay, so it's not just singling out China. I think they're saying sort out your debt issues first, then we'll disperse these funds. Now, the reason you need these funds dispersed is because you're cash strapped. That is the reality as a country. We're cash strapped. We are horribly cash strapped because of the situation that we're in. So you do need a float. It does happen, Vernon, even for individuals. If you find yourself in a state of bankruptcy, usually you are restructured and floated a little bit of cash to try and help you through the short term and interim, but there are behavioral and structural changes. That's why the IMF comes to check and say, okay, what are you guys doing with your budget? How are things going? They, before they release any new money, they make sure you're adhering to the very recovery plan that you put on the table, and you're adhering to good budgeting principles. That's the main thing that's happening on the conversation there. So it's just simply about getting cash through and then trying to avoid short-term problems. Because Vernon, the reality is, if you are in bankrupt right now, you still need to eat tomorrow. You still need to do basic things tomorrow. So what we're trying to avoid is the short-term issues piling up more debt. That's what they're trying to avoid. They're trying to avoid short-term issues. And I think that is the role that the IMF's emergency credit facility plays. It's to cash-trap countries to avoid short-term pressure, but it comes on the condition that they make structural or behavioral changes in their spending. And therefore, those are the conditions. Now, they allow you to pitch your own conditions first. Then they'll say, okay, now we'll give you some financial support to help you through this period to avoid you going out there getting more debt to keep yourself going. Because Vernon, let's say you are bankrupt, things are tough, you've got people who you're paying. If that is happening to you, what ends up happening is just to eat food, you end up borrowing more money at higher interest rates. Just to move around, you end up borrowing more money to put fuel in your car. So to avoid all of that, the IMF has stepped in to say, here's some money to bridge. Here's some bridging finance. We've made it at very low interest rates, in fact, almost zero interest rates, just to give you, and we've given you 5 years before you have to start paying. So this should give you some breathing room to reorganize yourself and to reshuffle yourself so that you avoid borrowing for the meantime. And therefore, we are the only ones in this situation. Now, on the other hand of it, Vernon, one has to also understand the IMF is the proporter of the US dollar. So the more the IMF puts people in loans, the more we have to put dollars in our reserves. So whenever the IMF is bailing countries out, you start to notice that the US reserves start to pick up in people's bank, in central banks around the world. So just remember that. The IMF also has the agenda of keeping the dollar as the dominant structure, the dominant currency of the world. It actually has a job to do there. So before we start running away from that point, and I'm bringing that up because, Vernon, of our chart of the day. There's been deep conversations about this thing, about the end of the dollar. Everyone keeps saying the death of the dollar, the death of the dollar. Okay, people, let me just explain something to you. It takes a long time for these things to change. These are deeply entrenched structures interconnected between many nations. The death of the dollar is going to take many, many years. Even the pound hasn't truly died. And it took a long time for the pound to start getting waned off of the global economy. It took a while. Okay, America became the number one economy just before the turn of the 19th century, the 1900s, and then it took them to about 1944 to have a structural change. Usually, it takes a big world war or a long-term transition. It is going to take time to restructure the dollar, to remove it off its dominant position. We all have to stop being in debt to the IMF first, the whole world. We all have to stop being in debt to the US. We all have to stop buying oil in dollars, and the Saudis are not going to accept that anytime soon. Okay, they've started accepting it with China. Yes, those are structural deals that they're talking about, and they're talking. They're not exactly implementing. And you're hearing BRICS countries floating a single currency. Guess what? BRICS countries have been talking about that for the last decade, but that doesn't mean that it's not something that could happen. It just means it's not happening next week. Okay, a lot of people, the problem is we talk in social media terms. We're very instant about everything. These things happen slowly. Okay, I want everyone to really just start to slow down their time horizons. And I know you've gotten this fresh news. You can't wait to share it with people. You can't wait to know it. It's gonna take time. Okay, America is still going to be the dominant currency, until another country has more gold than America. Okay, right now China and Russia combined only have about 11% of the world's gold. America has about 25% of the world's gold. They are still a long way to go. We're still 20, 30 years away from such a huge restructuring. Regionalism first has to kick in. People have to be comfortable trading with each other. No wars have to break out. Then they start to transition. Do you know that when they started conceptualizing the euro to when the euro fully started getting traded, that took 10 years? Okay, it took 10 years to do that. Mm-hmm. And they'd been talking about the euro for some time before that. But when they fully put it on a piece of paper and said, can we now agree to it? From the agreement to the actual implementation took a decade, people. So slow down your time horizons. Don't react. Just relax. Okay? I don't think we're going to see the end of the dollar. It's going to be a tough one if we see the end of the dollar in our lifetime. possibly in the next 30, maybe in the next 30 years, if we start to see a reorganization of the global economy, America is still the number one economy. China is still struggling to catch up with America. By the end of the decade, yes, China will probably catch up. India will then catch up with China. India is the biggest country in the world in terms of population right now. So these are just some changes that are taking place. But monitor them, keep an eye on them. Maybe certain things won't grow as fast, but those are some changes you can watch out for, but doesn't mean you have to start reacting to them as if everything, let's dump our dollars instantly. That's why the dollar's getting weak. No, people, the dollar's getting weak because there's some dollars coming into Zambia. It's not happening around the world. It's just happening in Zambia right now. It's not a signal of the end of the dollar. Okay? Please be careful about those sentiments. You might catch yourself on the wrong side of things. So here's our chart of the day, Vernon. This is the percentage of currency holdings of global forex reserves between 2016 and 2022. You can see that, yes, the dollar was at 65% of global FX reserves. Now it's at 59.14, the lowest that it's been. Okay, it's at the lowest. But it's still 59%, people. It's still 59. Second there, the second biggest one you're seeing there is the euro. The euro was at 19.44%. Now it's at 17. It's at 19.5. The rest of the world currencies have gone from 5.83% to 7.92%. The other one there, the red one, is the Japanese yen, which has moved from 3.97% in 2016 all the way up to 5.3%. By the way, this is based on IMF data. Now, we've got this from the IMF website, which has this data going all the way back to 2016, and the tables going back all the way to 2016. You're also taking a look at the British pound. British pound was 4.49, now it's 4.83. So when you take the British pound, okay, and the dollar together, right, what you are seeing when you're taking the British pound, the euro, and the dollar, they still make up 84%. The Western blocks of FX reserves still make up about 84% of the world's reserves. Okay, and remember that this is not even America. America only has about $500 billion of its reserves. Okay, America has about $600 billion of the reserves. About 11 billion of the world's global reserves is sitting in the US, sitting in US dollars. Sorry, about 7 billion of the world's global reserves is sitting in US dollars. Okay, so the rest is outside. The rest of the world. China has got a lot of US reserves. China has got about $3 trillion in forex reserves, of which it mostly holds it in dollars. Russia, yes, still holds a lot of euros. So as long as dollars, euros, and pounds are the major component of forex, the one, yes, which is growing quite fast at the top there, you can see, is the Chinese renminbi, which has moved from 1.08% to 2.79% of global reserves. That is true. You are seeing fast growth in China and the rest of the world. Yes, you are seeing fast growth, but we are still seeing dominance of the top three, and if we add Japan in, the top four. So these ones are not even making 10% yet. Okay, please, people, this is the reality. They're just the China and the rest of the world, are just making about 11% of the global economy's forex reserves. So to start making current investment decisions based on that, that's a very dangerous thing to do. Now, what's the driving force behind this? I want to remind you of gold. Gold has to back money. And I know people want to say, but we don't use gold. Yes, we do. America, 75% of US dollar reserves are in gold. Okay, there's a reason why. The majority of EU reserves in most of the EU countries, be it Germany, Italy, Netherlands, France, they're holding gold. Okay, so it should tell you that there's something about gold. So remember that the Western blocks are still holding. The Western blocks have gone from 24,000 metric tons of gold down to 21,000 metric tons, and obviously a lot of that has shifted to China and Russia. China and Russia have gone from 774 metric tons to 4,200. So if you're looking in percentages, China and Russia used to be 2.3% of the world's gold. Now they're 11.97%. America was 24.43%. Now they're 22.94%. America is the single biggest nation out of the single nations that holds the most gold as a single nation. Okay, so they're holding almost a quarter, just almost about a fifth. So two out of every 9 tons of gold is sitting in America. Okay, so they still have the strongest gold holdings. But when you put America and Europe together, they make up 61. America, Europe, the IMF and the Bank of International Settlement. You know that the IMF is the third biggest holder of gold in the world. The IMF. Okay? Because they'll say, no, gold is not important. Gold is. Then tell me, why is the IMF holding so much gold? Why does the IMF own so much gold if that's the case? Because they know that gold is important. It's an important reserve hedge. So they've got the IMF, the Bank of International Settlement, the US, and the EU together have 61% of the world's gold. They used to have 72, but it's 61. Yes, these trends are slowly moving away, but China and Russia are still not strong enough. You have to mount up enough gold to be able to then attack the US's currency. That is difficult to do. And there's another thing you have to recognize. China is not interested in its currency being the number one currency. That's why it lends in dollars and not renminbi. We've been trying to get deals to get China to give us loans in renminbi, but even they don't want to do that. And the reason they don't want to do that is simply because they don't want their currency becoming the global currency, because that makes their currency too strong. China banks on the fact that its currency is weak and it allows it to trade cheaply. If the Chinese currency gets too strong, its exports start to suffer. So that's what China is trying to avoid. This happens to every country that becomes the number one economy. If your currency becomes too strong, your exports become too expensive, and therefore your industrial sector starts to suffer, and the world looks for cheaper places to produce so that they can take your products out. China is not interested in the renminbi becoming the number one currency right now. They're not interested in it, because it has horrible implications for their industrial sector, and they still have 900 million people that they want to push back into the middle class. They've got a very big middle class, but they still have about 900 million people they'd like to push into the middle class before they start becoming a global economy and avoid the middle class trap. So just also to give you a final look at this in terms of gold purchasing, Russia and China, yes, are the fastest growing. And I'm going to give you a quick news clip about this just to show you. Russia and China are the fastest growing in terms of gold buyers. Switzerland, France, and the IMF have been the biggest gold sellers. Yes, the IMF has been selling its gold so that it can go out and try and help the world in terms of the situation. But Russia and China have been buying, and the Bank of International Settlement has also been one of the top buyers of gold. So there is net buying happening, but Russia and China, yes, are the biggest buyers. Biggest sellers have been Switzerland, France, and the IMF. They've been selling their gold portfolio. And part of the biggest news here is that China expands its gold reserves for the fifth consecutive month. The Chinese have been pushing up their gold reserves now above. They now have above 2,000 tons of gold themselves. So China is currently responsible for about 10% of the world's gold. They've been pushing themselves heavily in terms of gold purchasing around the world. So that doesn't change that they are actually making some very big strides in terms of gold purchasing. But once again, don't make decisions on this stuff without actually truly understanding what's going on. That, to me, Vernon, is what I think everybody should be paying attention to. So our chart of the day does say, in as much as you may be talking about the death of the dollar, that is not a death. It's not the dollar getting shot in the head and dying instantly. It's a slow decay. And we should not be talking about the death of the dollar more than we should be talking about the slow decay of the dollar. That is true. The dollar is decaying in its position, but it's actually being challenged by the yen, the pound, and the euro at the moment. Those blocks are opting to keep more of their currency rather than US dollars. That is where the changes are coming from right now. China is slowly growing, and the rest of the world is slowly growing. Even Russia, by the way, Russia's top three reserves right now, its top three reserves are euros, gold, then dollars. Okay? So even Russia mostly holds euros because it receives them from selling oil to Europe. So I don't know if that makes sense, Vernon, about the conversations of the death of the dollar. Oh, yeah. And I know we just need to quickly transition away before we get into our final conversation.
All right. All right, so finishing up on those thoughts around what, of course, we have for you today on Behind the Markets with Mutwale. All right, there we go.
Right. So, topic of discussion today, I'm going to talk to you about a few about investment mistakes. The three key, and I'm going to give you Munyumba's three key investment mistakes that people make whenever they're investing, Vernon. Here are the three things you must watch out for in yourself. Please, people, learn from mistakes. If not, you'll make them. But the good thing is that if this lesson sits in your mind and you do make these mistakes, you will remember them. So at least just remember them. Okay. And at that time, if you can in the comment section, please write these three down. Consumption. Consumption is having poor savings rates, Vernon, or withdrawing from your investments too much. Whenever you get paid a coupon, you spend it. Whenever you get paid a dividend, you spend it in terms of instead of reinvesting. Whenever you get paid rent, you spend it in terms of putting it into building a new housing project. That is consuming your asset before it has matured to the point where it's capable of taking care of you. So premature consumption, withdrawing from it, your retirement accounts, those are things you have to try and avoid. The second one is conservatism, and these are in order of number one to three. The second one is conservatism, excess conservatism, not factoring in inflation. In other words, keeping things in cash too much, being too afraid to make any decision. These are things that usually hold people back. And the third one is carelessness, poor diversification. You shouldn't over diversify, but you can also poorly diversify where you've got excess concentration. You're keeping things where you're looking at speculative price rather than cash flow. This happens a lot with land investors, people who just buy up land on the hopes that they can sell it. That's actually carelessness half the time because what happens is that if you find yourself in a bad market, you lose a lot of money. Overexposure to exotic assets, thinking you're going to get rich in Bitcoin next week, all the best with that one. Hype investing, hearing people, oh, this is the latest thing, this is the latest thing, and then you go and rush all your money into it. That's a huge mistake people make. And short term thinking, oh, I need to get rich in the next 2 years. And what ends up happening is you end up getting poor because you threw all your money into a huge barrel that you did not pay attention to. You most likely got swindled. You made a very bad investment and you ill timed the market. So often that is where the problems come. These are three areas, Vernon, that people suffer with. One of the things I also tell people, one of the other mistakes people make is trying to do things for themselves when they may not have the expertise to do so. So I always say, put yourself to the test. And the test is very simple, Vernon. It stands for, do you have the time? Do you have the energy? Do you have the skills and systems? And do you have the temperament yet to be making investment decisions by yourself without any guidance? People like to say, why should I invest in a unit trust? I don't want to pay fees. Right. So next time when your dividends come and you end up chewing them instead of your unit trust provider reinvesting them for you, just remember you may not have the temperament. You may not have the patience. That's a temperament problem. Do you have the time to sit down and read financials a lot? If you lack the time to sit down and go through financials and analyze them properly so that you can make decisions on stocks, to analyze the economy properly and the macro conditions, perhaps maybe put your money in a unit trust. Okay. Do you have the energy to be doing that? You may have the time on your hands, but do you have the energy to do that? Do you have the skills and systems? Are you able to track data very well? Do you have access to analytics to be able to make those decisions properly? This is where the problems start to come in. Okay. So if you've passed the test, sure, self-manage. If you haven't, consider also holding things in unitized funds or in something similar because that is why this is the reason people self-manage. So if you're not able to put yourself to the test, then be careful. It's the same, Vernon, as a person who decides I'm either going to buy bread from the shops or I'm going to make my own bread in the morning. If you lack the skills and systems to make your own bread every day, perhaps go and buy it from the shops. Okay, that is one of the reasons. So think about it like cutting your own hair. Think about it like buying your own bread. These are important ways to look at it. So, what are some of the most detrimental mistakes people make in investing globally, Ben? And I'm going to take a quick look through this. As you can see, the biggest one there is not paying enough attention to your asset allocation. How much are you holding in what? And this usually comes from an over concentration. Now, I know some people like Warren Buffett have talked up against this, but Warren Buffett has an investment style that he's been very good at. But to the average person, I think you lack the skills that Warren Buffett has. Warren Buffett has very good skills he expects the rest of the world to have those skills. And he even says, if you lack the skills to do proper securities analysis, then hold on to allocations. But just accept that you're not a guru at investing. And it's true. The majority of us are not gurus at investing. Okay, so I think that's what we all have to recognize. Don't try and invest like a guru when you're not. The second biggest problem Vernon people face is trying to time the market. Oh, this is when I can get in, so that when it peaks, I can make a lot in 1 year. Because people try to time the market, try to make too much money too quickly. So the two biggest problems are poor asset allocations, not trying to time the market, and too much and having too much money in one investment. So asset concentrations. So these three, sorry, are your key winners in what's driving you. Some of the other things that are there: buying overvalued investments and holding on for too long when you can see something is losing. So there's a book called The Biggest Mistakes. And these are the five biggest mistakes I'm going to quickly name out from this book. These are five big investment mistakes. Warren Buffett invested in a company called Dexter Shoes after investing in two other shoe companies. Now, it looked similar, but Dexter Shoes was not the same. Warren Buffett learned a very strong lesson: similar does not mean the same. Okay. What he missed was that these guys did not have an economic moat around their business, and they were very open to competition coming to whack them over the head. And as a result, he lost a lot of money. He calls this his worst investment ever. Okay, so Warren Buffett did see that happen. Mark Twain, who was really a writer, invested in a publishing house, and this is something called the law of the holes. Unfortunately, he was making huge losses in this publishing house, but kept on putting more and more money in to keep on reviving it. If you can see fundamentally an investment is dying, quit while you're ahead. Okay. And what that simply means is that if it's made a 30% loss, don't emotionally hold on to something because for some reason you feel the need to be right. The law of the holes is this: if you find yourself in a hole, stop digging, get out. Okay, that is what happens. If you find yourself going deeper and deeper into a hole, I saw this happen with Lafarge stocks or Chilanga Cement stocks back in 2016, when the stock price plummeted from 24 to 6. People were literally just watching that thing collapse, okay, with hopes and prayers. That thing was overpriced at that time. So it should have been a signal to people to exit that stock, and especially because its competitor had finally become active and that stock plummeted. Okay, the third level is Bill Ackman, the legendary investor in Herbalife. Bill Ackman went around calling Herbalife a scam. He said, "This is a pyramid scheme. It's a scam. I don't know why it's a listed company. It's a scam." As a result, what he didn't recognize that Herbalife actually did have an outright product. It was a health services product. It was just sold through multi-level marketing. But that doesn't mean there wasn't a product. To call something a pyramid scheme, they shouldn't actually be a product in there. Okay, so yes, Herbalife did have a lot of activity in terms of people buying for reselling, but there was an actual thing happening where people were actually utilizing it. So Bill Ackman constantly called it a scam, even in the face of investment. So even in the face of evidence that was showing this thing was not a scam, he kept on holding on to his position. And the lesson you learn there is: watch your ego. The purpose of investing is to make money, not to be right. So if you are wrong, and it's okay, switch your decision. Okay, market, your tone does not dominate market. I have to switch positions on things sometimes. I have to change position on certain things. Okay, because making money and even for clients, guiding them to money making decisions is more important than being right. Okay, fourth lesson was by Stanley Druckenmiller, who was a very good macro investor and decided to invest in tech stocks. He made horrible losses because he used the same assumptions from macro investing in tech stocks. And the lesson there is: stay in your lane, or at least know where you're good at. Success in one area doesn't automatically guarantee success in others. Humble yourself first and learn about that area before you start going in. That's something I had to learn with crypto markets. Before I made a lot of decisions on crypto markets, but then I went through a 2-year learning period before. So that is one of the things I started to do very carefully, and I've had to change positions on it subtly, because I've had to understand what it is deeper and deeper, because we've all been live learning here. And the fifth one is Benjamin Graham's leverage lesson on leverage. Always pad your portfolio in a way that you can survive short-term losses and then still capture long-term gains. Benjamin Graham borrowed for a long-term transaction, and he ended up being wrong, and he lost 70% of his portfolio because he borrowed heavily. So always pad your portfolio. This is called the barbell strategy. If you want to be free to make mistakes and to take risks, Vernon, this is what you do. You can do it in personal finance, you can do it in investing, and you can do it in business. What you simply do is that you put a lot of conservative assets, okay, into your portfolio. For example, you put quite a large component of bonds, and then you put some stocks so that when the stock market takes off, you are able to rally with it. And that, Vernon, is our breakdown of it. I'm going to quickly just give you our quote of the day. And I'm quickly going to rush to that. That comes from that comes from Warren Buffett. He says, invest in companies
Yeah.
so wonderful that an idiot can run them, because sooner or later one will. A bad leader will eventually come. However, the biggest mistake he does say is this: when he was asked, what is your biggest mistake? He says the biggest mistakes are the ones that actually don't show up as mistakes. They are mistakes of omission rather than commission. We never lost that much money on any one investment, but it's the things that I knew enough to do, but I didn't do, where I missed profits of almost $10 billion. Warren Buffett was supposed to invest in Walmart quite a long time ago, but he decided not to because he judged himself and he was scared. It was the fear of making a mistake that ended up costing him $8 billion in Berkshire Hathaway profit that year. That is sometimes the biggest mistake. So don't be afraid to make mistakes. Just don't make detrimental mistakes. Learn from other people's mistakes, but quickly learn from your own mistakes. That, Vernon, is where I'll round up today.
Thank you very much.
Thank you very much and have a good day.